You know, sometimes, Carl, people just don't get it. They'll sell a stock because the company didn't say, beat and raise, beat and raise, beat and raise. But the company may be doing very well. And here I'm speaking about Cisco, whose stock appears under pressure for the moment, even though they really kind of crushed a lot of the aspects that I look for. And I also think, by the way, some people felt guidance was off. I think guidance was strong. So joining us now for a CNBC exclusive interview, Cisco Chairman and CEO Chuck Robbins. Hey, Chuck, did you have a bad quarter?
I think when you look at our product order rate being the highest growth in over a decade and the largest quarter in the history of the company, and the team's just executed incredibly well. We have, we had $4 billion in software revenue in the quarter. We had 160+% growth in our sales to the cloud providers. And there's even more. But, I mean, it was just a great quarter. Our teams did a phenomenal job, and I'm really proud of what we accomplished.
I've always, since I followed your company, since when Mr. Morders was CEO, I always looked at orders as the way to be able to figure out what was going to go. Enterprise up 25%, public sector up 22%, commercial up 41%, service provider up 40%. I'm used to seeing service provider. Why is that down 9%? Can you tell me what's going on? So, Chuck, this seems very, very broad-based, despite the fact that you had to say at the beginning that you do have the Delta variant and you're not sure exactly what's going to happen.
Well, when you look at that order growth, Jim, I think for years the service provider segment has been a headwind. And, 5, 6 years ago, we sold absolutely nothing to any of the cloud providers, the web scale players. And we worked hard for years. We designed our own silicon. We've built new products, the Cisco 8000, and we've won franchises as they go through this 400 gig transition. So that part of our service provider segment was up 160%. But our telco carrier business was up double digits. Our cable business was up double digits. And that web scale cloud business now comprises 30% of that segment. So it's meaningful. So the teams did great. Enterprise is doing really well in light of hybrid work and hybrid cloud and, this whole Wi-Fi 6 and rebuilding their infrastructure for the return to office. So there are just a lot of great transitions that are happening that are in our favor right now.
Chuck, I have always asked you and your predecessor, Mr. Chambers, would you please give us yearly guidance? And the rap was always, Jim, it's an uncertain world. You gave yearly guidance last night.
We did, Jim. If we go back several years, we started this transition to create a more predictable business model, more recurring revenue, more software. And, as of this quarter, we're on a $16 billion run rate in our software business. And in Q4, 81% of that came from subscriptions and SaaS. So what that fundamentally does is it gives us more visibility, and it gives us the ability to look out over several quarters and have greater conviction about what our revenue is going to be. So we felt comfortable doing it, even though it's a bit of an uncertain time. And, this is one of the benefits of having Scott Herren, who's gone through this transition at Autodesk before. He really understands how this works. And so we felt comfortable doing it, and we thought it was time.